Chapter 8, Master Budgeting. Hello all. Chapter 8 is all about master budgeting. A budget is defined as a detailed quantitative plan for the acquisition and use of financial and other resources over a given period of time. Budgeting is a process of developing a formal, written operating plan that presents management's planned actions in financial terms. Budgeting should reflect the goals of the company's strategic plan and its operating plan. The must know for this chapter include one, knowing the sequence in which budgets are prepared, two, how to apply assumptions provided to budget calculations, three, how to calculate the various budgets and their accompanying schedules, four, how to link budget results to the income statement and the balance sheet. Budgets have two key purposes: planning and control. Planning refers to developing goals and preparing various budgets to achieve those goals. Control, on the other hand, refers to gathering feedback to ensure the plan is being properly executed or modified as circumstances change. To be effective, a good budgeting system must provide for both planning and control. Good planning without effective control is time wasted. Tools for control will be covered in Chapter 10, Variance Analysis. The master budget is the sum of a series of interrelated operational budgets produced by a company's various functional areas. The word master is used because it includes all of your company's budgets. The master budget details the sales, production, and financial goals of the firm. The master budget includes two categories of budgets: the operating budgets and the financial budgets. The operating budgets include the sales budget, production budget, and SGA budget. The operating budgets focus on expected revenues and expenses and their effect on earnings. The operating budgets basically plan out your profitability. The second category of budgets are the financial budgets. Financial budgets include your capital budget, cash budget, and the pro forma income statement and the pro forma balance sheet. When you see the term pro forma, you need to think of the term projected. So a pro forma income statement is a projected income statement, while a pro forma balance sheet is a projected balance sheet. The focus of the capital budget is on investments in projects, equipment, and acquisitions. The capital budget will be covered in Chapter 13. The cash budget details the expected cash inflows and outflows from operations and the need, if any, for financing. As you know, the income statement lists the revenues, expenses, and operating results for the budget period, while the balance sheet provides a listing of all assets owned, liabilities owed, and the owner's equity position at the end of the budget period. The master budget is typically presented in either a monthly or a quarterly format and usually covers a company's entire fiscal year. This slide shows you the components of the master budget. As you can see, it all starts with the sales budget. The sales budget answers the questions: how much are we going to sell? When are we going to make our sales? How much sales revenue will be generated? Closely tied to the sales budget is the expected cash collection schedule. The cash collection schedule tells us when we are expecting to get paid. The current period cash collections will always include collections of accounts receivable from the prior periods, plus cash collected from current sales. The production budget determines how many units need to be produced each period. The inputs for the calculation include the units of projected sales plus the desired ending inventory minus the beginning inventory. Closely tied to the production budget are the direct materials budget, the direct labor budget, and the manufacturing overhead budget. The direct materials budget allows us to plan for the materials on hand to satisfy the production needs. The schedule of expected cash disbursements tells us when we plan to pay our suppliers. The current period cash disbursements will also include payments on accounts payable from prior periods, plus payments made for current period raw material purchases. The direct labor budget tells us how much people will work and at what cost. The manufacturing overhead budget determines how much fixed and variable overhead we are expecting to incur. The finished goods budget allows us to determine the product costs for units produced during the budget period, as well as the value of the ending finished goods inventory. The selling, general, and administrative expense budget determines the expected operating costs for doing business. At this point, we have completed the operating budgets. We have produced schedules showing our sales expectations, our production goals, and our SGA costs. Let's turn our attention to financial budgets. As stated earlier, the financial budgets include the cash budget, the pro forma income statement, and the pro forma balance sheet. The cash budget determines if we have enough cash to carry out all our operations, or if not, how much we need to borrow. The cash budget will show all cash inflows from collections and all cash outflows for disbursements. To the extent that we have excess cash, we will look to make investments. To the extent that we have cash deficiencies, we will borrow money. As you already know, the income statement will provide readers with an understanding of company profitability by matching revenues with the cost incurred. The balance sheet provides readers with a good understanding of how the company's management team has handled investments and managed risks in both the short term and the long term. The budget process begins with a budget committee made up of individuals representing the key functional areas of the company. The budget committee addresses policy matters, coordinates budget preparation, and provides oversight and feedback. While committee members are made up of members from top management, the process is typically participative, meaning that managers across the whole organization are involved. While the budget process is long and challenging, it is a necessary ingredient for operating success. As this final slide shows, a good budget will, one, communicate management's plan throughout the company. Two, force management to think about and plan for the future. Three, uncover issues and bottlenecks before they occur. Four, coordinate department objectives within the firm. This ensures that everyone is on the same page. And five, provide benchmarks or standards for evaluating subsequent performance. So that's it. I don't think you will find budgeting difficult to understand, but I know you'll find it tedious as you complete drills and solve problems. As you will see, budgeting involves lots of steps and many calculations. Give yourself plenty of time for homework because you'll need it. Once again, thanks for watching this video. It's time to do some drills. Good luck.